Hello and welcome back to the channel everybody, Wall Street Warrior here. Today we're delving into a topic that has intrigued economists, investors and financial enthusiasts for decades. It is, of course, in case you didn't guess by the title, the correlation between the US dollar and gold. In this short video we'll unravel the complex relationship between these two powerful forces in the global economy. So grab your popcorn and let's dive in. The basics. To understand the correlation between gold and the US dollar, we must first, of course, grasp the basics. The US dollar is the world's primary reserve currency. What this means is, it is the primary currency used for international trade and finance. For example, the US dollar, or USD for short, is the primary currency used to trade oil globally. Now, if you imagine the amount of oil used all around the globe every day, cars, planes, trains, automobiles, factories, all the other uses for it, the amount of it the world needs, the flow can't be interrupted, it will destroy the economy and have other far-reaching effects. So to alleviate complexity of factoring in things such as forex exchange rates when trading such vital commodities that the global economy needs, and to ease the flow of goods around the globe, the US dollar is used. This is what we mean when we say the US dollar is the world's primary reserve currency. It's also worth noting that many central banks around the world, especially ones who have currencies more prone to extreme fluctuations, they also tend to hold large amounts of dollars in a similar way that many banks hold gold. They do this to help stabilize what they have, essentially. The story begins with the gold standard, where once upon a time, major world currencies were backed by physical gold reserves. This was done by central banks around the globe holding large amounts of physical gold, usually in vaults beneath the central banks themselves. Many still do today, though not to the same degree they once did. Each dollar bill or pound note was essentially a promissory token, or a sort of IOU for the equivalent value in gold. As the US established itself as the economic powerhouse post World War II, the dollar became the anchor for this system. However, the Bretton Woods Agreement in 1971 marked the end of the gold standard, shifting economies to the current system we have today, the fiat currency system. Fiat money is a type of currency that is not backed by gold or any other commodity, gold, silver, anything. It is typically designated by the issuing government to be legal tender, i.e., a $10 bill is worth $10 because we all agree it is. So, here's a slight sidetrack, but it's a really interesting point about gold. And if anyone's ever tried to sell you gold, they'll probably tell you this story. But it has a lot of sense to it. Okay. If you can imagine back in the times of ancient Greece or ancient Rome, one gold coin back then would have bought you, let's say, the finest toga, right? Today, one gold coin, a 1 ounce gold coin, say a Britannia, you could sell that for around £1,650, okay? You could still go and get yourself a really nice suit with that £1,650. Maybe not a toga, I don't know, don't think they're so popular nowadays, funnily enough. But you can still get yourself that same suit, the same quality, right? So the moral of that story is the gold coin, thousands of years ago, has basically the same intrinsic value as it does today. Now we move on to discussing the inverse relationship. So, one of the key dynamics in the inverse relationship between the US dollar and gold, when the dollar strengthens, the price of gold tends to decrease. So, think of it like this: when the dollar strengthens, gold weakens, and vice versa. This is due to the opportunity cost of holding a non-interest bearing asset like gold when interest rates are high, making dollar denomination investments more attractive. For example, when inflation is high, your money sat in the bank is essentially losing value. So gold sounds like a better place to put your money, as its price always rises given a long enough time frame. Whereas when a bank's interest rates are high, your money can grow at a steady rate, making gold therefore less attractive. Think of it as a kind of a seesaw. When interest rates are low, gold does well. When interest rates are high, the gold price slumps. Gold is seen as the king of safe haven assets, and probably with good reason. A safe haven asset, for those of you who don't know, is one which is expected to maintain or even increase its value during periods of economic uncertainty and market turbulence. Investors seek safe haven assets in such times in order to limit their exposure to possible market downturns or uncertainty within the markets. Gold's role as a safe haven also plays into the relationship with the US dollar. So, during times of economic uncertainty, investors flock to assets like gold, driving up its price naturally. This can be triggered by geopolitical tensions, financial crises, or even pandemics, as we've seen relatively recently, as well as a myriad of other macroeconomic factors that, honestly, the list is practically endless. Quantitative easing and dollar depreciation. So the correlation between gold and the US dollar is further influenced by central bank policies. Obviously, they are the big players in the market. Bigger than any hedge fund, bigger than any one trader, bigger than anything. Whenever there's big moves in the market, it's normally a central bank. That's why they're so careful to not say anything, or try not to say anything most of the time. It's because they know when they make waves, it reverberates through all markets, okay? So the correlation is obviously greatly affected by them. For instance, during periods of quantitative easing, where central banks go to town printing banknotes, therefore injecting new money into the economy, the dollar's value can decrease because there's more of them, right? There's more dollars. So the dollar's value can decrease. This depreciation often leads to an increase in gold's price. It's the seesaw effect we were speaking about earlier. The reason for the appreciation in the price of gold during these times is generally based on investors trying to find some stability and seeking somewhere stable to put their money. Quantitative easing in itself is an extremely in-depth and fascinating topic, and it definitely deserves its own video in the future. But for the sake of keeping this video under 50 hours, we'll leave the deep dive on QE for another day. Global supply and demand. Beyond the domestic factors, global supply and demand also impacts this relationship. Gold has its industrial uses, such as trace amounts of gold can be found in many electronics, including cell phones actually, containing tiny amounts of gold. Disclaimer, please do not smash your iPhone to bits trying to get the 0.034 grams of gold inside. You may well regret your life choices. Gold is often bought by central banks for diversification of their portfolios. Also, fluctuations in demands influenced by emerging markets and geopolitical shifts can affect the dynamics between the dollar and gold on occasion, leading to short or long-term price fluctuations in gold and strength or weakness in the dollar. Again, it's generally the seesaw effect. One goes up, one goes down. It's not impossible for them both to go up or down on the same day, but more often than not, it's the seesaw effect in action. Now we move on to current market trends. So let's talk about recent trends. Over the years, the relationship between the dollar and gold has evolved due to the changing economic landscapes and new market participants. Cryptocurrencies, like Bitcoin, have emerged as alternative assets. There are so many cryptocurrencies now, I don't think anyone could name all of them. Of course, there are some that are bigger players than others, Bitcoin being the king, so this is why we use it for an example here. So, new assets like cryptocurrency are adding a new layer of complexity to the mix Think of it this way. Your money, everyone's money, has to reside somewhere. Most of us are happy enough to just let it sit in the bank, in our bank accounts, where it either grows at a slow and steady rate, or its purchasing power rots away over time due to inflation. Either way, the bank account is one of the safest places to store your money. But the very nature of investing is seeking, whether it's the safest place for your money or seeking the place with the most growth potential. This is where market trends, geopolitical events, and people's opinions make waves in the ever-changing financial landscape of our modern world. Investor strategies. For investors, understanding the correlation between the US dollar and gold is crucial for crafting effective strategies, whatever they may be. Some use gold to hedge against dollar volatility. For example, there's the old adage of have 20% of your portfolio in something defensive. So back in the day, there used to be the old 80-20 split, which was hold 80% equities and 20% bonds. I don't think that works so well nowadays, but you can see the logic in this, right? It's about having some defensive assets as a hedge, whereas some of your money can be more adventurous. This is why many people choose gold as the defensive part of their portfolio, whatever percentage that might be. While others leverage the dollar and the dollar's strength for short-term financial gains. Ultimately, a well-rounded approach considers both assets and its unique characteristics. But let's be honest, if you have a stack of dollars and a few gold bars, you're doing pretty well for yourself compared to most people. So, now let's look to the future of this inverse relationship or correlation. So, what does the future hold? As economies continue to evolve and new technologies reshape finance, AI, I'm looking at you, the correlation between the dollar and gold might undergo further transformations. No one knows what the future holds for any stock, any asset, or the correlation between the two. I don't have a crystal ball. It's essential to stay informed and adapt to these changes, no matter what markets you're in. New technology changes markets. New approaches, new ways of thinking change markets. Although this correlation has been around for a long time, and I think it's pretty safe to say it's going to continue well into the future. Though if the past can teach us anything about the future, it's highly likely that the price of gold will continue to rise over time, on a long enough time chart. And the dollar will continue to reign supreme as the world's primary currency. Of course, there are other currencies out there trying to challenge the dollar for supremacy. Certain countries now looking to trade oil in different currencies, but the dollar, for now, definitely remains king currency, shall we say. And there you have it, folks, the intricate dance between the US dollar and gold. This relationship, shaped by historical context, economic policies, and global dynamics, is a testament to the complexity of the financial world. Thank you so much for joining us today. If you enjoyed the video, don't forget to like, subscribe, and hit the notification bell for more enlightening content. Until next time, stay curious and keep exploring the fascinating world of finance. I've been Wall Street Warrior. Thanks for listening.